We're talking about valuation in small businesses. Valuation for small companies, especially the closer they are to a startup, the trickier the conversation always is. The good news is that valuation is actually extremely simple. The bad news is that how you calculate valuation is very complex. But the topic of valuation is very simple. Valuation for a company is simply a net present value. It is the net present value of the future earnings of a company and ultimate takeout, and you discount that over a period of time to say, what is that worth today? So if a company loses money for the first 4 years and starts making money in years 4, 5, and 6 and sells in year 7 for a big number, you discount that rate, that amount of money over those years, and you look at that net present value. So once again, the good news on valuation is that everything is a net present value. But since it is complex to calculate, and especially the discount rates that are involved, especially with smaller companies and earlier stage companies, can be as high as 60, even 70%. That is a contentious topic on what is the right discount rate, what are the pro formas, what are the likelihood that they can achieve the objective and actually sell the company for this amount of money in the future. So that's where investors are going to come in and say, for a startup or an early stage company, well, it's $1 million. And the entrepreneur is going to say it's $10 million. And there's a big disconnect. But where small business owners, entrepreneurs, executives can be successful is to think about and to take the time on what are the amounts of money that this company could earn over time and what could be the ultimate takeout value. And what does that look like on a net present value? So when they sit down with investors, they can have an intelligent conversation about this. And if you can't agree on a pre-money valuation of $1 million, $2 million, $5 million, and you've truly got a disconnect from $1 million to $10 million, you can figure out how to put a security in place that bridges that conversation to a later time anyways. This happens in the form of convertible securities. You have traditional convertible notes. There are new documents in the marketplace that are convertible securities or convertible equity. And you can also do things where you've got preferred securities, where investors are willing to give a higher valuation, but now want more control, whether it be board seats, voting rights, liquidation preferences. So valuation by itself is a topic that can be addressed even if there's differing points of views. And it's all about how you negotiate and structure the security, the form of investment that comes into the company. And when you have an idea of what a company can achieve, revisit that model over and over and over again, because your valuation and your likelihood to be able to achieve those pro formas, those financial goals, is always going to change. But as a business owner, the best thing you can do for yourself when interacting with investors is to be prepared to have the conversation and level the playing field between you and them, so you can have that dialogue and make it meaningful and come to an agreement on how much money should go into the business and who should own what percentage, because that's what matters. Check out our resources, additional resources at INVESTyR.com. And don't forget, invest your reputation.